I'm significantly concerned about it because the amount of money and credit that has to be produced and is budgeted is a large increase. And yet, if it's not spent, it produces its own problems. The markets have a sensitivity to that. So what it means, and then there's a supply-demand picture for bonds. And the way it looks is if you should get the selling of bonds, it worsens that supply-demand picture, because the way it works is the Treasury borrows and runs a deficit, but it can't produce money. So it has to sell bonds. And when it sells bonds, if there are not enough buyers of those bonds, then the Federal Reserve got to come in and print money and buy those bonds. And the world right now is over invested in US dollar denominated bonds, pension funds on the 60-40 mix, and they have negative real returns. And cash has a lot of negative real returns. So if there was a selling of that and a moving to other assets, stocks, other assets, commodities, other assets, or other places, other currencies, other real estate and the like, that selling worsens the supply-demand picture. And then if there's not enough demand, that means that the central bank has got to come in and print more money. So yes, it's not only the inflation that's in the pipeline or projected in that supply-demand balance, but it's also what it could be if there's a selling of debt instruments. The three things that you mentioned are financial conditions, the production of debt and money to monetize those, the internal conflict over wealth and other things, politics, the greater extremism, and then the rise of a great power to challenge an existing great power in the form of China. Those three things never happened in my lifetime before, but they happened throughout history. And when I learned that to be surprised, I knew that I needed to study prior periods. The reason we anticipated the 2008 financial crisis was because we studied the Great Depression. And so to answer your first question about the first of those, I view it just very much mechanically. Buying power, which comes in the form of money and credit, when that's produced in a quantity which is much greater than the incremental production of goods, services, and financial assets, drives those financial asset prices to go up. And the printing of money, the monetization of debt, is a last phase in a long-term debt cycle, because it indicates that when there's a lot of debt, that debt monetization has its effects. So what we're seeing now in the market is very, very, very classic. It's happened repeatedly, in that enormous amount of buying power created by the creation of money, which doesn't raise living standards, that is passing through the system. And so you're seeing it happen in the inflation of goods, services, and financial assets. I express very little opinions in the book. I do express opinions, but what I thought was very important was to have objective measurements. So you see 18 different gauges that include a variety of measures of relative strength. Measures such as education, productivity, building of infrastructure, how many inventions come out of the country, many different measures of performance. So those objective performance measures are the most important thing I could get across. So anybody can watch those. They're like a health index. You can see if the levels are going improving or deteriorating, whether the income and balance sheet thing is improving, any of those. So it was most important to me not to be ideological or opinionated. I don't think my opinions matter as much as the reasoning behind that. And that's why I put those in, and also created a model that has a cause-effect relationship. I looked at 10-year leading indicators of output. In other words, everything that happens has causes that make it happen. And by being able to measure those cause-effect relationships and putting them into graphic and numerical form, and then using those to then give an indicator, I could show what happened, and that's what my objective was. So the reader of the book will be able to make their own judgments. What you see in the book are really those measures over time, repeatedly through the rises and declines of empires. There's a trade-off that I think everybody has to understand, and that's related to the second. With the large wealth gaps and large not enough money in lots of places, the Federal Reserve and the Treasury were put into a position of needing to get checks out. And there's also this left-right conflict issue having to do with the wealth gap. And that means that you have fiscal policies that are now requiring lots of spending. And so the question is really, are the consequences of not doing that better or worse than the consequences of doing that? Now, when we look from an investor's point of view or an individual's point of view, we have to remember that you can't raise living standards by just creating money and credit, particularly if you don't raise productivity more than that. And that means that those asset prices are going up. So we're in the phase of the cycle, very classic, that the financial asset prices have gone up because you've given them more money, that demand is going up, and now we're having inflation of those assets. So if a lot of that buying power is going to be pulled back, particularly as we go into the next year. But there's still going to be a lot, and there's still going to be a high level of inflation of those types of assets. So the trade-off is always the question. It's a reflection of the state of where we are in the cycle, that we have borrowed. It's all the problems that we've gotten ourselves into by acquiring too much debt and spending more than we're earning rather than being more productive, and also not distributing the opportunities and the incomes in a way that it's a broad-based prosperity. So on the one hand, you have a prosperity that this bottom 60% of the population isn't participating in very much. And at the same time, you have, so it's creating that polarity. And at the same time, you have the financial markets. So those are trade-offs that, different people, the only thing I care about is whether we're productive, whether we increase the size of the pie through productivity and then divide it well so that you create something closer to equal opportunity that produces greater political stability and also draws on the population going wide. And the reason I say that is because I've studied these empires, these dynasties, going back since the last 500 years. And you see the same thing happening over and over again. When there's a financial problem, when the granaries are empty and the coffers are empty, they print money. And when they print money and the coffers are empty, it devalues money. And with that, when you have a large gap of people at each other's throats, then you create a risk of an internal conflict, a risk of some kind of civil war. And that is what I think is we're at risk of.